Welcome back to another episode of With Sonar. We are officially in the back half of 2023. We had our 4th of July yesterday. We hope you all had a great 4th of July, or for any of our Canadian viewers, you had a great national holiday on July 1st, which was not long ago as well. So, Tony, glad to be back here. We've got a lot to talk about today. We're going to talk about where the markets have been for the first half of 2023, what happened over the holiday, and then as a result of that, where are we likely to go for the rest of the year? Before we get there, though, what did you do on the 4th of July?
I played golf yesterday. So
great thing to do.
I managed to lose $50, but, you know, it is what it is. It was one of the better rounds this year. So.
Did you lose $50, or was $50 the price of entertainment?
I lost $50.
Okay. I was trying to put a positive spin on it here, okay? But that's, I guess, not where we were going with that. Beautiful day here in Chattanooga yesterday for some golf. Where did you play at?
Creeks Bend.
Creeks Bend.
It was a little warm. What'd you do?
Well, I went to the pool. I'm a pool guy. I had kids. Got to get them entertained, get in the water. Hopefully they don't drown. They didn't, thank you. So no need to send any child services to my house. Everybody was perfectly safe. But no, we had a good time at the pool. Ate some great food, obviously watermelon, you know, and the works and the, you know, the cooking out, all the stuff. And then thankfully, still have all my fingers from fireworks last night.
Nice. That's what I was going to ask.
Big win.
Firework night?
Big win. We do, you know, my kids are at the age where it's like, you do the fireworks, but we're not quite at the big stuff yet. Eventually, they're going to ask for that. And I'm going to have to make a decision on, do I want to risk my life for their entertainment? I mean, the answer is probably yes.
Yes.
But, you know, that thought will go through my mind. But anyways, we had a good time, and hopefully you all had a good time as well, and we're safe out there and whatnot. So, anyways, 4th of July, we're officially more than halfway done with 2023. Mm-hmm. It's been a tough 2023 for I think a lot of the world, but especially the freight markets, which, you know, give us the update. What's happened in 2023?
Yeah, I mean, you've seen you've seen historic lows in certain freight metrics or metrics that gauge the freight market. Right? You look at the outbound tender rejection index, it hit right around 2.5%.
Yeah.
Back in early May, that was the lowest level that we've seen ever since the COVID lockdown.
Yeah.
But when you really think about the freight market, there's kind of this natural floor for rejections, right? They can't be zero,
right?
Because capacity imbalances and things like that. So, I mean, you're talking 97.5% compliance, like it's almost unheard of.
Yeah.
And I think what you're seeing is shippers are expecting high levels of compliance right now, because ultimately, if they're still shipping contracted freight, it's still at a premium to the spot market. Mm-hmm. So there's really no incentive for a carrier to leave the contracted market. There's no incentive. I mean, there is incentive for a shipper to leave the contracted market, but you're
up to a point.
Yeah, but you are also risking service levels. So it's one of those. You're paying at this point. You're paying a premium for service. You see freight demand been kind of in the decline. Not real decline. It's been fairly stable off of last year's decline.
Yes.
I think what's setting up, though, is for further declines as we progress into the back half of the year.
Yeah, especially as we look towards import volumes, which are continuing to really just not improve at all. Yeah. And you would expect this time, when the domestic freight markets tend to have a fairly muted July. July tends to be fairly muted, right? Mm-hmm. Historically, even when we look pre-COVID, that's the case. Even back in the bull run of 2018, that was the case. However, the ocean markets tend to start ordering more goods in the summertime.
Yeah, I mean,
we're not seeing that yet.
Yeah, I mean, you've seen a little reaction, right? I mean, it's nothing to like write home about, right? I mean, if you look at the inbound ocean TEU index, there has been a little upward movement, but it's nowhere where it needs to be to kind of show strength is coming back or demand
in line to support a good freight market at 2019 levels.
Yeah, I would venture to say that. And I think what's interesting is we're setting up, so you have to think peak season on the ocean is really August, September timeframe. So we're kind of in the early stages of that. I think you're seeing, you don't see them necessarily the West Coast, but now you're seeing the strike in Canada for those West Coast dock workers, right? So that's taken hold, which doesn't really affect that much. I mean, it does affect inbound volumes, but I mean, you're still seeing there are some levels of demand, but there's so many risks, I think, in the back half of the year, especially after you've heard the Supreme Court ruling or decision on student loans and that student loan forgiveness that basically says the president doesn't have the executive power to write a check of that size. It's of $400 billion. But I think those risks are going to present themselves in the coming months. And I think what's interesting is we always talk about the ocean being upstream, right? But I think this is an area where retailers were having to order now, and you saw some upward momentum prior to this, that stuff's already coming. So it may actually be the domestic market that kind of shows where freight demand is, as opposed to further upstream, which is kind of this interesting thing. I mean, you see it happen. It kind of happened in really when the bull run started back in 2020, right? The domestic market led the maritime market, right? You saw movements increase in OTVI prior to it growing in imports, right? So I think it's an area to pay attention to, but seeing the little bit of upward movement we've seen right now is nothing to things aren't going to get necessarily infinitely better or much better, right? It may just be because there's no guarantee that once this stuff hits, it goes right into a truck, right? It can go rail, it can end up in a warehouse for months before it actually flows to the domestic transportation market, if it flows at all, right? Because retailers are still dealing with inventory levels that are way too high.
Companies are still reducing inventory levels. We saw an article about that today.
Yeah, so
that they're reducing or reordering inventory at I think 3-year lows.
Yeah, so I mean it's a slower pace of all of these things, and I think that's ultimately going to affect what drives the freight market in the back half. Maybe moving away from some of the ocean movements. I think that's what's going to be interesting.
Let's go ahead and pull up tender rejections here for folks to see. I think this will be a nice little summary for everything we've experienced this year, but also to give a little perspective on how the markets have ultimately performed and handled 2023, but also most recently 4th of July. So tender rejections in blue there. Yes, we've seen it go down consistently this year. That was also the case for 2022. So starting this year at just a smidge above 7%, and now we're effectively half that level at about 3.5%. Off of the low point there in May. But what we want to call out is we didn't even, Tony, when we're looking at tender rejections here, to get through the 4th of July and not even touch 4%, I mean, that basically says that shippers were able to get through 4th of July with almost no additional spot market exposure. Like the need to have to dip into that with that kind of rush going into 4th of July was almost non-existent.
Yeah.
Almost.
I mean, you think about it, 4th of July is kind of the peak time for freight outside of the fourth quarter, right?
Yeah.
Like that carriers should have all the momentum, which they had a little. I mean, you do see an upward movement, and I think directionally you see that show up in rates, which we'll touch on here in a little bit. But really, it just kind of indicates that there is no pressure. No. And shippers firmly have pricing power in the market. And I look at this and it's, what is the catalyst to drive this thing back up to 5, 6, 7%, which is an area that you kind of deem a normal freight market. Yeah, a normal freight market or healthy freight market. Like there has to be a demand side rush, which doesn't seem likely, or you have to have a mass exodus of capacity, which you haven't seen, right? It's been this like kind of slow bleed. Any capacity lost hasn't amounted to anything to kind of firm this up. So, I mean, I think this indicates that the market still has way too much capacity, right? Yeah. Even though you saw rates move slightly higher into 4th of July, it's expected. That's what you should see.
That's more of a sentiment move, though. Like, we're going to look at those rates here shortly. And honestly, my theory behind rates moving up is it's simply just a sentiment of everybody's like, well, it's 4th of July, so they have to move higher. This index here gives a tiny bit of justification for it. But not a lot.
Yeah, I think the way to think about this, and I try to think about it I think of it similarly to how I think about the stock market as well, right? The price sometimes can break away from the fundamentals.
Yes.
Right? Eventually it comes back because sentiment can drive price, momentum can drive price, right? They take an inch and they start to see it, well, they try to drive momentum and prices here in the freight market. But it only lasts so long, right? The fundamentals of what's actually happening, which is what this rejection index shows, eventually will come back into alignment. And I think that's what we're going to see. I mean, ultimately, to me, it shows that there's just, if you are a spot exposed carrier, good luck, because we're in a period right now that, I mean, and it's been good luck we started talking about this earlier than this last year, right? That it was like reduce that exposure. Well, if you're exposed, you have to think less than 3% of tenders or 4% of tenders are getting rejected. So if 96% compliance on contracted freight, of that, how many are getting accepted by the next carrier in the routing guide?
Oh, yeah.
Right? Like, this is an aggregate, but like, if we saw first tender acceptance, like what is that? But then what is second tender acceptance?
Oh, yeah.
I think that's going to be what's interesting. And I think that's going to be interesting when we hear earnings calls, because some of the brokerages talk about first tender acceptance and like the depth of tender. I think that'll be, it'll be remarkably low, right? I mean, you're talking, it'll be probably the lowest level it's been in years. And you look at this for the second quarter, because again, rejection rates were 3% for the entire quarter.
Very low.
So it's one of those,
very low.
If you're exposed, it's going to be, this next quarter is going to be difficult for sure.
And I would expect July to, for the most part, just be in a steady, slow decline of tender rejections further, even from here, unless some type of catalyst comes into play. As far as what that is, I can't see it.
Yeah.
But yeah, I mean, it does feel like, that's a short blip, and we're probably going to come back down closer to the 3% range. Let's go ahead and pull up volumes for folks to see, because obviously volumes are a big driver of what happens to capacity and pricing. Right, it's much further upstream. So here we are, dark blue shaded line is where we are today. You've got the subsequent different years there to see some of that history. And that big drop off you're seeing right now, that's just 4th of July. Ignore it, it's noise. We'll probably bounce right up again. But I think the thing here to look up is when we bounce back up, when volumes kind of return to normal. We kind of have this weird week right now because 4th of July is in the middle, so we may have to wait until Monday of next week before we really start to see normal volumes again. It'll be how close above, below, or right on that purple line is what I'm going to look at to kind of see how the back half of the year is going to be. Because 2019's back half from a volume perspective was actually kind of decent. It had a decent Q3.
Yeah, I mean, it was relatively stable. And I mean, you saw upward movement in August, which you don't typically see. Right. And then September was fairly stable. So, I mean, you're talking about 2 months that typically aren't the greatest from a truckload perspective. Right. That were okay from a volume perspective.
Okay from a volume perspective.
They weren't great in terms of there was still too much capacity in rates. But I think it was setting up, like 2020 was set up to be a difficult first half of the year, and the market was going to make subsequent improvements throughout the year. And then we have COVID, obviously. But I think what this is, we're still trying to reset to whatever this level's going to be. So, I mean, I look at it, if you look in June in 2019, and really June outside, I mean, every other year, right? 2022, 2021, I'll exclude 2020 just because it was an incredible run. You saw upward movement in volumes during the back half of June into July, into the 4th of July. We did not see that this year. And I think that is the concern is, we didn't see the movement that we would have typically thought you would see. And if this thing bounces back, I mean, I just don't see July being any better. I mean, I look at 2022, it was a slow decline throughout 2022, July of 2022. Even in 2021, from after the 4th of July through the beginning of August, volume levels were in decline. If we continue that, we are going to dip below 2019 levels, and that's a concern.
I think there's definitely a real possibility we dip below 2019 levels. The consumer has been fairly resilient for a lot of things, though. So I think ultimately the question will become how much of their spending do they allocate towards physical goods versus services? And it's been services has been the winner here exponentially. So ultimately, especially with student loan repayments coming back, there's definitely some curveballs out there. But yeah, I mean, there's a possibility we jump below 2019 levels. As far as what does that do to the market, obviously, further softening. I don't know how much it pushes rates down further or how much more rejections go down. I mean, again, there is a floor there with rates. We're already starting to see it on the spot side. Carriers are just starting to park trucks.
Yeah,
saying, I'll wait. So there is a natural floor that does get hit. But what it could do is prolong that floor that we're there.
Yeah, I think that's the key is we've talked about it, like, is the market at a bottom? Well, does it really matter if it's at a bottom? I mean...
Yeah, what's getting us off the bottom?
Yeah, that's the key. Like, if we're at the bottom and we stay there for 6 months, does it really matter that we hit the bottom? Because the conditions haven't changed in 6 months. Like, they're still not great, right? It's what drives the up cycle eventually. And right now, it's hard to see anything that's going to be a driver, right?
Yes.
I think people and things I've heard about, like with yellow and the risk at yellow, right? Can that freight be absorbed? Well, odds are a lot of that freight has already been, I mean, once that news kind of comes out that you're on the brink, people start moving freight.
Yes.
You have to, Yellow's biggest customer is also the government. So outside of the government, which is a nightmare scenario, like that's a whole different process from other shippers, right? They're able to go and find other capacity. The government, it's a more taxing issue, but those shippers are probably moving things away from Yellow as is.
Yeah.
People thinking that might be a catalyst to drive this, it's hard to see that. It may just be a reallocation of freight into a market that has enough capacity to absorb it without any real changes. So, I mean, I think that's going to be an interesting one that plays out. But, I mean, in terms of a volume recovery or rebound, it's hard to see one in any significant manner in the back half.
Yeah. Well, maybe, Tony, you should start buying more stuff so we have a rebound.
Hey, services spending is ruling. I mean, I'm going to Hilton Head in like a week. That's where any excess money feels like it's going toward travel, or it's being spent on food out. And not
that
home.
Seems to be a general. Like, we can talk about the month-to-month trends, but like for the most part, for the last 4 or 5 decades, the last at least 50 years, it seems like the general trend has been moving more towards services with just the general economy. I saw this chart the other day, and I don't remember the exact timeline. I want to say it started in the 50s, so about 80 years ago. About 70 years ago. Sorry, math sometimes. And goods, as far as like the economy was concerned, was somewhere around 60%, maybe 65%. We're almost flipped. I mean, because now goods represent about 35%. Services are about, I guess 65%.
Yeah, so I mean, you're talking almost over half, right?
Right, over half is in services right now. So that's been a general trend. Just to kind of put on your crystal ball hat for a minute, do you think if that trend continues long term, what does that do to the freight markets?
I mean, I think one of the things you have to remember is people still spend money on goods.
Oh, they're always buying stuff.
They're always buying stuff, yeah. Right? So it's just a matter of like, I think one of the things you have to pay attention to is inflation metrics, because again, those measure in sales, things like that are measured in dollars, not actual physical volumes. So you might buy an iPhone that's $1,500, right?
I would not.
But it's $1,500, but it's a very small volume, right? If they sell a bunch of them, how many iPhones can fit in one truckload?
A lot.
A lot. So,
actually, I've got a question about that. If anybody has ever moved smartphones of any kind in a truck, do they load up the whole truck?
That would be a lot.
That's a lot of money in one truck.
Yeah. So, I mean, there's things like that. You have to, like, those spending trends on like what you're spending on, right? Because again, CPG prices are up, but volume, I mean, if you're spending more, or say, I guess one example, I look at like a Kroger or a grocer, right? Look at their same store sales, right?
Yeah.
Level inflation goes up, so, but sales are flat. People are spending the same amount of money,
dollar-wise,
but volume levels are probably down, which is obviously not a good thing for the freight market. So I think that's a trend you have to pay attention to, is not just one, how inflation plays an impact on all of this, but like where those dollars are being spent. Because, like for me, this is personal. I mean, I live in a 750 square foot apartment. I can't buy a lot of things. Like any discretionary income likely goes to a service, because I can only put so much stuff. How many people are out buying furniture? I mean, obviously when you move houses and things like that, but a lot of that stuff got done in the pandemic. So like where you were redoing your house and buying new electronics, things like that, these durable goods, the big spending trends, they're kind of, how do those play out? I mean, if we continue to spend on services, it's obviously, you're kind of getting back to a normal freight market, but what is normal, I think, is the biggest question. Everybody talks about a normalization, but what is normal, I think, is going to be...
We're still finding out.
Exactly.
We're still finding out. Interestingly, though, is spot market rates from a line haul perspective have pretty much been in line with 2019 levels for the last couple of months. Let's go ahead and throw up NTI here, our National Truckload Index, which measures daily spot rates here in the U.S. So currently, now this is all in, includes fuel. So we're sitting at, I believe that's $2.32 a mile right now in U.S. dollars. So you can see what I want to call out. Obviously, it's been in decline this year. If you remember the tender rejections we looked at on the last chart, it's going to feel similar. It's down, hit a bottom in May, back up. This is where I want to talk about how sentiment drives price more than actual market fundamentals. Tender rejections right now are really a true measure of how capacity is able to handle demand. We already saw it peak before the 4th of July, and it's already started coming back down. Rates here have not, meaning there's still this sentiment that's driving those rates up. So that line straight up there going to $2.32 a mile from about $2.22 a mile, that's not going to last.
Now, it's not.
It's going to come back down.
And I'll say this because it's a 7-day average, right? I'm looking at the day. I've got the daily pulled up right here. It peaked out at 237 on July 1st and July 2nd. So kind of that, it goes in line with what we saw in tender rejections. That lead up into the 4th is where we saw it.
Yes.
It has fallen back down to 230, right? And that was on the 4th because it is a day behind. So you're talking the NTID, so the daily, is below the 7-day average, the day of the 4th of July. How does that impact over the next week? Because typically it takes about a week for capacity imbalances to work themselves out.
Yeah.
It sure doesn't look like there's any strength in rates to hold them at 230, right? It feels like we're very quickly going to revert back to that 223, 225 range that we've been in for really the last 2.5 months.
Yeah, I think somewhere, I think you said it right, somewhere in that 220 to 220. I'll give you a big range, 220 to 227.
Yep.
You're going to fall somewhere in there, and it's probably that's where you're going to hang out for a little while.
And what's interesting is
I don't think we retest those lows in May, though.
No, I think what's interesting, though, if you take out those lows in May, so it was a 2-week stretch that they were below 220.
Yep.
They were in a 9-cent range from 220 to 229. At the time, it was from April 9th all the way through.
Well, yeah, you can see it right there. If you take out that initial dip and this little pump we're seeing right now, it's basically flat.
It's basically been flat for 8 of the last 10 weeks.
Yeah.
So
we're going right back to that.
Yeah. There's no...
Unless tender rejections or volumes do something none of us can see, we're going right back to that.
Yeah, it's one of those. Yeah. There doesn't seem like there's anything.
I do want to call out one thing, though, before we leave. Let's go to the next chart real quick. We're going to look at the spread between spot and contract, because I do think this is, if there is a cause for catalyst that we can see right now, this would potentially be one. So, typically spot and contract rates are within 5, maybe 10% of each other, right? It's typically where that spread is. We can see this chart's here over the last 4 years, 4.5 years now. So spot rates are in green, line haul, which is why they're a little low. And the blue line is contract rates. They're also line haul right now as well. So contract rates are continuing to fall. Spot rates there, again, a little bump off their bottom, but we don't expect that to really go anywhere. The spread right now is 48 cents a mile, which is the lowest it's been in quite a long time, right? It's the lowest it's been really for the last 18 months. It's the lowest the spread has been. When that spread kind of continues to crunch, right? And what I'm looking at is if contract rates really hit 220 a mile, that's basically like you're in that threshold, that 5 to 10% range.
Exactly.
If they start to go, contract rates fall further than that, right? Then you could have a crunch between, okay, now the big contract carriers can't really sustain themselves any longer. They've been able to ride this down wave. Lower volumes definitely hurt, but they've been able to ride it enough with these higher contract rates. But if that continues to fall there, and that could take 6 months, could take more, could take less, but 6 months is probably a good benchmark. If those compress too much, then the markets will flip at some point. But anyways, that's all the time we have for now with Sonar. So we'll see you live next week. In the meantime, have a fantastic rest of your day and enjoy your post 4th of July.